This is Minaketan Solangi, Associate Professor, Shikha Anusandhan Dimtim University. In this presentation, we will discuss on demand for money. Major central questions in monetary theory is determination of the value of money and the stability of money demand function. To answer to the first question, like many in economics, lies in the supply and demand for money. The stability of money demand function can be answered through whether and to what extent the demand for money is affected by interest rate and other factors. Therefore, study on the demand for money along with the supply of money is very important in monetary theory. Basically, people demand money because they wish to have a command over real goods and services with the use of money. Most fundamentally, the demand for money reflects how much wealth people want to hold in liquid form to purchase goods and services. Therefore, demand for money is in nature of a derived demand. Different economics provide different views as to why people and firms demand money. We'll discuss basically three major theories relating to demand for money. First, the classical approach to demand for money. Second, neoclassical approach to demand for money. And last, Keynesian approach to demand for money. Coming to classical approach to demand for money. Classical approach to demand for money is discussed through the quantity theory of money, originally called the quantity theory of exchange. It is mainly developed by Professor Irving Fisher in his book The Purchasing Power of Money in 1911. According to the classical economist, demand for money arises because money primarily acts as medium of exchange. All transactions involving purchase of goods and services, raw materials and other assets require payment of money. Value of the transactions made determines people's demand for money. For example, if a person purchases 5 commodities at a price of ₹5 for each, the value of transaction is ₹25 and he will demand ₹25 for this. In any given period, the value of all goods and services or assets sold must equal to number of transactions made, represented by capital T, multiplied by the average price, represented by capital P, of these transactions. Thus, the total value of transactions made is equal to PT. In accounting identity, value paid must be equal to value received. Thus, the value of goods and services and assets sold must be equal to the value of money paid out for them. Value of money paid out is the money supply in the economy. This money supply is equal to the nominal quantity of money in circulations, represented by capital M, multiplied by the average number of times the quantity of money in circulation, that is capital V, which is known as the velocity of circulation. Thus, the total value of money flow is equal to MV. For example, if a 5 rupee note, capital M, changes hands 5 times, capital V, the total quantity of money in circulation is ₹25, that is 5 multiplied by 5. Here, the velocity of money is the circulation of the same 5 rupee note for 5 times. Symbolically, Fisher's equation of exchange is written as MV is equal to PT, where M refers to total quantity of money in circulation including coins and banknotes, V transaction velocity of circulation of money, P general price level, that is measured through weighted average of the sale price of all goods and services, T the total volume of transaction. This MV is equal to PT is an identity, that is true by definitions. However, by taking some assumptions about the variables V and T, Fisher transformed the above identity into a theory of demand for money. Nominal quantity of money, represented by capital M, is fixed by the central bank of a country and is assumed to be given in a particular period of time. Volume of transactions, represented by capital T, is considered as constant and in the short period is independent of M. Velocity of circulation represented by capital V remains constant, which is independent of M, P and T and is determined by institutional and technological factors involved in the transactions process. Money acts as a medium of exchange and no portion of it is hoarded. Given these assumptions, Fisher presented a direct and proportional relationship between quantity of money and the price level. In equation form, it is represented as P is equal to mv by T. The equation mv is equal to Pt takes M as primary money, that is notes and currency. Since demand deposits with the commercial banks affect transactions in the similar way as currency does, Fisher's revised version of demand for money is expressed as mv plus m prime v prime is equal to Pt, where m prime and v prime refers to the amount of bank money and velocity of circulation of bank money respectively. Therefore, the price level P is equal to mv plus m prime v prime whole divided by T, and the value of money is represented through 1 by P, that is equal to T divided by mv plus m prime v prime. Take an example. If the volume of circulation of notes and demand deposits in an economy are rupees 10 crores and 20 crores respectively, velocity of circulation of primary money and bank money are 4 and 5 respectively, then the price level is calculated as rupees 4, keeping total volume of transaction is rupees 35 crore. If M and M prime doubles to 20 crore and rupees 40 crore respectively, then the price level is calculated as 8. That indicates doubling of M results doubling of P. Now coming to what are the criticisms leveled against Fisher's quantity theory. The first criticism, MV is equal to PT is a mere truism and have no practical significance. Second, the model holds that M, V and T are exogenously determined, whereas it is observed that during prosperity, price level may be pushed up by an increase in T. Third, the assumption of constant ratio between M and M prime does not hold true during depression, where due to lack of confidence in the banking system, bank deposits fail to increase even with increase in notes and currency. Fourth, the model suffers from inherent technical inconsistent. That is, M is measured at a point of time, whereas V is measured over a period of time. Fifth, this theory does not able to explain the process through which increase in the quantity of money causes an increase in aggregate money spending, resulting in an increase in price level. And the last, the price level is not a passive factor because an increase in price level leads to increase in production to increase profit, which results in increased volume of transactions and increased velocity of circulation. Coming to the second theory, that is Neoclassical Approach to Demand for Money. This Neoclassical approach to demand for money is popularly known as Cambridge version of quantity theory of money. This theory was developed by the great Cambridge economist Alfred Marshall and later modified by his followers like A.C. Pigou, D.H. Robertson and also James Keynes. Neoclassical economists hypothesize that income earners strike a balance between the convenience, that is transaction motive, and security, that is precautionary motive, that money provides, and the loss of income resulting from money holding, that is speculative motive. For satisfying these three motives, community desires to hold a specific portion of its annual real national income or output by way of cash. At any given point of time, aggregate demand by community for cash balance is not the total amount of money in circulation, but only a part of annual real income, which is designated as K in all versions of Cambridge equation for demand for money. According to Neoclassical Approach, aggregate demand for money can be expressed as MD is equal to KPQ or P is equal to MD divided by K Q, where Q is the real national output, P is the average price level of the currently produced goods and services. Therefore, PQ is equal to nominal income, and K is the proportion of national income PQ that people want to hold as cash balances. Given K is equal to 0.1, Q is equal to 4000 units, M is equal to rupees 2000, the average price of a unit of output is rupees 5. Shift in the magnitude of K influences price level even though the supply of money remains constant. In the above example, if the value of K rises from 0.1 to 0.125, price per unit of output will decline to rupees 4. Therefore, it is K and not M which is significant in determination of price level. Cambridge cash balance approach to demand for money is illustrated in figure 1. Demand for money in this Cambridge cash balance approach is a linear function of nominal national income where the slope of the function is equal to K. What are the important features of the neoclassical theory? Neoclassical theory tries to link price to the demand for money and not to the supply of money as in the Fisher's version, because idle cash balance does not in reality create demand and affect price. This theory hypothesizes demand for money is a function of the money income, and it also brings out the mechanism by which changes in the demand for money affects general price level by linking prices to demand for money. Evaluating neoclassical approach for money, certain economists they raise some criticisms against the neoclassical approach to demand for money. Cambridge cash balance approach did not look into the idle cash balance vis-a-vis alternative forms of financial assets, especially bonds, although they did recognize the asset function of money. Neoclassical economists although recognize that expected future prices and interest rate could affect the demand for money, it does not go further to investigate the relationship between interest rate and the demand for money. Cambridge economists did not provide any theoretical and or empirical evidence supporting unitary income elasticity of demand for money. Cambridge theory of demand for cash balance kept the influence of factors such as rate of interest, wealth, expectations regarding future price on the demand for money in the background of the theory. Changes in the price level may cause non-proportional changes in the demand for money, which negates price elasticity of demand equal to unity assumed by the neoclassical economist. Now coming to classical vis-a-vis neoclassical approach to demand for money. Fisher's transaction velocity MV is equal to PT or V is equal to PT by M, and Cambridge cash balance approach equation M is equal to KPQ or K is equal to M by PQ. Both the approaches attempt to analyze changes in the value of money in response to change in money supply. Assuming K and Q constant, interpretation of cash balance equation is same as Fisher's transaction velocity equation, that is, changes in the quantity of money cause proportional change in the general price level. Volume of transaction T is in Fisher's equation is same as the real national output in cash balance equation. Therefore, K is the reciprocal of V, that is K is equal to 1 by V. Keeping V is equal to 4, then we have K is equal to 1 by 4. This indicates if a unit of money on an average appears 4 transactions in a year, then money balance held by the people would be sufficient to buy goods and services produced in a period of 3 months. Since K is equal to 1 upon V, the factors affecting V automatically affects K. For example, an increase in the frequency of wage payments, say monthly to weekly, would possibly reach the velocity of money, and the people find it unnecessary to hold same amount of money which they held earlier. According to Professor Hansen, the two approaches are not same, and cash balance approach has an advantage over transaction velocity approach. According to him, Cambridge version of quantity theory, that is M is equal to KPQ, represents a fundamentally new approach to the problem of money and prices. Asserting K is equal to 1 by V is to miss entirely the significance of K in the Cambridge equation. As opposed to mechanistic nature of Fisher's transaction velocity approach, Q in the cash balance equation can be analyzed in terms of risks for holding money, and hence cash balance approach takes us closer to reality. Now we'll discuss Keynesian approach to demand for money. Keynesian approach to demand for money is also known as liquidity preference approach. It is an extension of Cambridge cash balance approach. It includes holding bonds and securities as an alternative to holding idle cash balance as an asset. It linked the demand for money to the variations in interest rate and introduced concept of speculative demand for money, putting emphasis on the store of value function of money. It signifies people's interest on purchasing power of money holdings, because if people are concerned with nominal money holding irrespective of price level, they will suffer from money illusion. Keynes mentioned the concept of liquidity preference in the context of demand for money. Liquidity preference in Keynesian economics is the degree of one individual's preference for cash over less liquid assets. How much of one's income will an individual hold by way of ready money, that is cash or non-interest paying bank deposit, and how much he will part with or lends depends on what Keynes termed as liquidity preference. According to Keynes, desire for liquidity preference arises because of three motives. First, transaction motive; second, precautionary motive; third, speculative motive. Coming to transaction motive, the transaction motives relate to the demand for money or the need for money balance for the current transaction of individuals and business firms. Individuals hold cash in order to bridge the interval between the receipt of income and its expenditure. Holding of cash depends on three things. First, the size of person's income; second, interval at which income is received; third, method of payment norms in the society. A poor man holds less money for transaction motive as he spends less. Businessmen and entrepreneurs also keep a proportion of their resources in money in order to pay for raw materials and transport, to pay wages and salaries, and to meet all other current expenses incurred by any business firm. Transaction demand for money depends only on a real income. In functional form, we can say MT is a function of Y. Higher the price level, more money balance a person has to hold in order to purchase a given quantity of goods. In Keynesian system, proportion of income held for transaction motive is constant and fairly stable in short term. Therefore, MT is equal to KY, where K represents a constant proportion of income demanded for transaction purpose. The straight line sloping upward marked MT is equal to KY in the figure 2 shows positive relationship between income and transaction demand for money. In Keynesian system, money demanded for planned and committed transactions do not depend on a rate of interest and is assumed to be interest inelastic. Payment for grocer's bill, house rent, electricity and telephone bills, school fees and medical bills, etc. remain constant irrespective of changes in rate of interest. However, transactions demand for money also influences by higher rate of interest. Transaction demand for money is interest elastic beyond interest rate I3 in figure 3. Higher rate of interest means high cost of holding cash balance, and people began to rationalize their expenses. Business began to reduce their inventories, and holding of bond increases, then holding of cash decreases. Coming to precautionary demand for money, precautionary motive for holding money refers to the desire of the people to hold idle cash balances to meet unforeseen contingencies. The unforeseen contingencies may be sickness, accidents, fire, theft, loss of job, death of breadwinner, and market eventualities. Further, people take advantage of to promote their interest from unforeseen opportunities like fall in the prices of bonds and consumer durables. The amount of money demanded for this motive will depend on the psychology of the individual and the conditions in which he lives. Precautionary demand for money is also a positive function of the level of income, that is MP is equal to KY, where K represents a constant proportion of income demanded for precautionary purpose. Precautionary demand for money is also interest elastic if interest rises beyond a certain level. Keynes lumped transactions and precautionary demand for money together and expressed the total transaction demand as M capital T is equal to KY. Coming to speculative demand for money. Speculative demand for money is demand for money as store of wealth. Wealth can be stored in the form of landed property, bonds, money, bullion, etc., which can be clubbed in a single category called bonds. According to Keynes, there are two types of assets, money and bonds. Deposit of cash in savings bank account earns interest and purchase of bonds provide monetary return on it. People compare rate of return on bond with rate of interest on bank deposits. People's decision to hold cash or to invest in bond depend on their speculation about future changes, that is rise or fall in interest rate and the relationship between interest rate and bond prices. Analysis of the relationship between the interest rate and the bond prices demonstrates how such speculation works. Consider you purchase a perpetual government bond by paying the then prevailing market price of rupees 1000 that entitles a payment of rupees 50 per year. This perpetual bond is purchased at a market interest rate of 5% per annum. This market interest rate is calculated as 50 by 1000, that is 0.05. The formula for estimating the present value of a constant income stream, that is V is equal to R by I, is used here, where V is the present value of the income stream, R is the annual return, and I is the interest rate. How much would this bond be worth if you try to sell it today? The value of a financial asset that entitles the owner to an annual return of rupees 50 per year depends on the current market rate of interest. First, suppose the current market rate of interest is 5%, at which the bond would be sold for rupees 1000. If the market rate of interest increases to 10%, the bond can now be sold at rupees 500. It is calculated as V is equal to 50 by 0.1. Even though you paid rupees 1000, given the rise in interest rate, you will be able to sell it only at rupees 500 with a capital loss for rupees 500. If the market rate of interest decreases to 2%, bond can now be sold at rupees 2500, that is calculated as V is equal to 50 by 0.02. Even though you paid rupees 1000, given the rise in interest rate, you will be able to sell it at rupees 2500, thereby you have a capital gain of rupees 1500. From these examples, we can infer market value of bonds and market rate of interest are inversely related. A rise in market interest rate results in a capital loss on previously existing bonds, and a decline in market interest rate results in a capital gain on previously existing bonds. If market rate of interest is very high and everyone expects it to fall in future, that is rise in price of bond, thereby anticipating capital gain from bond holding, people will convert their money into bonds, indicating speculative demand for money is very low. In figure 4, at a very high rate of interest, say 15%, people convert their entire money holding into bonds, indicating speculative demand for money to be zero. If the rate of interest is low and people expect it to rise in future, that is, there is a fall in price of bond, anticipating capital loss from bond holding, people convert their bonds into money in order to avoid future capital loss. Therefore, speculative demand for money becomes very high, so much so that when the rate of interest declines to the minimum, say 3% as in figure 4, speculative demand for money becomes infinite or perfectly elastic. This pushes the economy into liquidity trap and the speculative demand curve becomes flat as shown in the figure. What is the concept of liquidity trap? Liquidity trap is a situation of very low interest rate where the speculative demand for money schedule becomes nearly horizontal. In such a situation, individuals believe that bond prices are too high and will therefore fall, and correspondingly that interest rates are too low and must rise. They therefore believe that to buy bonds would be to incur a capital loss, and as a result they hold only money. Keynes pointed out that during depression, when the rate of interest is very low, the demand for money becomes completely elastic. The rate of interest has fallen enough and cannot fall further. Keynes' theory assumes that each individual has its own view about the long-run equilibrium interest rate and that there corresponds to this a critical rate below which our individuals holds only money and above which he holds only bonds. Clearly, if everyone is holding money at each one is in the liquidity trap, then the current interest rate must be below the lowest critical rate situation. However, in practice, there is no statistical evidence to support the existing liquidity trap. Coming to how total demand for money is calculated. Total demand for money consisting of transaction demand, including the precautionary demand for money, and speculative demand for money. The transaction demand and the precautionary demand vary positively with the income, whereas speculative demand for money is negatively related to the interest rate. Symbolically, we can express MD is equal to MTD plus MDS. In functional form, we say MD is equal to KY plus F of I. The transaction demand for money, precautionary demand for money, speculative demand for money, and total demand for money is represented in the figure 5A, 5B, and 5C. 5A represented the transaction and precautionary demand for money. 5B represents the speculative demand for money, and two motives have been added gives to the total demand for money and is represented in figure 5C. Now we will critically evaluate the Keynesian approach. Keynes' speculative demand for money visualizes that people hold their assets in either all money or all bonds, which is quite unrealistic as individuals hold their financial wealth in some combinations of both money and bonds. Transaction demand for money is insensitive to interest rate, which is negated by Baumol and Tobin, and they showed that money held for transaction purposes is interest elastic. Keynes' additive form of demand for money function has been rejected by the modern economist on the ground that money represents a single asset and the same unit of money can serve several motives. It has also been argued that speculative demand for money is not only a function of rate of interest but also depend on size of total assets or wealth. The difference between the normal and current rate of interest, which is the basis of explanation of speculative demand for money, disappears if current rate of interest remains stable over a period of time where people take it to be normal rate, and with this the speculative demand for money disappears.